The ex-dividend date is one of the most important markers in dividend investing, but also one of the most confusing. In this video, I'll not only walk you through the dividend calendar dates, I'm also revealing 3 dividend investing strategies you can use to maximize your returns. We're talking dividend stock strategies today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, everyone in the community knows I'm a big believer in dividends. These cash-paying investments have been shown to beat the market, and at times, that dividend yield is the biggest chunk of the market return. You see here a chart of the total market return by decade, and that dividends have accounted for about a third since 1926. But in some of those decades, like the 70s, it's been as much as half the total return. But there's a very important part of dividends that most investors just don't understand or are a little confused about. It's the process where a dividend is declared by the company and how it's determined if you get that dividend or not. In this video, I'm going to show you the important dividend calendar dates to watch for, and then I'll reveal 3 dividend investing strategies around these dates and 2 tips to boost your returns. So when a company decides to pay a dividend, it's because the board of directors has approved that cash payment and declares the dividend. From this date, the declaration date, you usually have about 30 days before they record who gets that dividend. Whenever you hear that a company has declared their dividend, they'll announce what's called the ex-dividend date. This ex-dividend date is the first day that the stock trades without the dividend. It's ex that dividend payment. That means you need to own the shares on the day before to get that payment. It's not shown here, but sometimes investors call the day before the ex-dividend date, they call it the cum dividend date. So in our example here, and we'll cover another example with Apple dividends later. Here, Microsoft, though, announced that they'd pay a dividend on November 29th, and that the ex-dividend date would be February 14th. Usually it's only about a month between the declaration and the ex-dividend date, but here it's a little bit longer. If you owned shares of Microsoft on the close of February 13th, you would get that dividend. When trading in Microsoft opens on the 14th, those shares don't include the dividend. It usually takes the company a couple of days to get the book straight to see who exactly owned the shares on the 13th, so that's why the record date is later. Then usually a few weeks later, the actual payment of that dividend goes out on the payment date. Now, an interesting thing usually happens on that ex-dividend date, and this is going to feed into our dividend calendar strategies. Because the company has committed to making that cash payment to investors, and the shares on the ex-dividend date don't include that cash payment, the company is technically worth less than it was the day before. If the company pays out a $300 million dividend, and remember, this is just accounting right now because it actually hasn't paid that dividend money out. It's just sitting in Microsoft's bank account, but it doesn't belong to the company. It belongs to those shareholders that have that dividend coming. Then the company's value is $300 million less than the day before. Now, it doesn't always happen exactly, and we'll go into why, but most of the time you'll see the share price fall by about the amount of that dividend on the ex-dividend date. This is why it's so important to know these dates. You might have collected that dividend, but now the shares have fallen in value by about the same amount. Now, I want to share those 3 dividend calendar strategies that you can use to take advantage of all of this. First, though, I need your opinion on something. I want to get a feel for what kind of investors we have here in the community, whether you're long-term investors or looking more for those short-term gain ideas. So in the comments below, let me know how long you're usually holding your investments. So more than 5 years, 3 to 5 years, a year or 2, or less than a year. Scroll down and let us know how long you usually keep an investment and how you make that decision. So part of understanding these dividend date strategies is understanding the taxes around dividend investing, and this is really going to affect your returns. Now, dividends are taxed in one of 2 ways. If you own a dividend stock for more than 60 days, either before or after that ex-dividend date, so the total time you own the stock has to be 61 days and include that ex-dividend date, then the IRS says that it's a qualified dividend and you get a special lower tax rate. On the other hand, if you own the shares for 60 days or less, you don't get that special rate on the taxes. You collect the dividend, but it goes on your taxes as regular income and you pay those regular income tax rates. So let's look at a chart here because I know this can all be a little confusing. Let's just look at the one on the left for individuals. If you own a dividend stock for 61 days or more, whether it's before or after that ex-dividend date, then you pay capital gains taxes when you account for your dividend on your income taxes next year. You can see those tax rates in the orange are quite a bit lower than the income tax rates in blue. In fact, for a lot of people, they may not owe any taxes on their dividends if their income is low enough. If, on the other hand, you hold your shares for 60 days or less, you'll pay the ordinary tax rate in blue on that dividend. This is important to that dividend capture strategy that we'll talk about next, because obviously those higher taxes are going to affect your returns. Now, I've got a trick to avoid these higher taxes that I'll share in a minute, but first I want to get to that first dividend calendar strategy. Now, this first dividend strategy is called the dividend capture, and this is by far the most popular I've seen, but I've also got two other strategies that are going to help you make higher returns. The dividend capture strategy is buying the shares just before the ex-dividend date, so buying them on the day before and then selling on that ex-dividend date. This means you get the dividend, but you don't hold the shares very long, so you're not really investing here on any price moves up or down. The beauty of this strategy is that it's so simple. There's no analysis, there's no stock picking involved. Now, like we said, a lot of times the share price is going to fall on that ex-dividend date because new investors don't get the dividend. So what a lot of dividend capture investors are going to do is they're going to wait during that ex-dividend day to see if the share price rebounds a little. This happens a lot, actually. Investors get over that knee-jerk reaction of the shares not trading with the dividend, and they bid the stock price back up. So sometimes with this strategy, you won't see the stock price rise all the way back to where you bought it on the day before, but it will come up a little bit from that first initial reaction. This means some of the dividend gain is going to be offset by a loss on the stock price, but you'll still have a gain. The great part about the dividend capture strategy is there's always a stock going ex-dividend on any particular day, so you can just roll this one over every single day. You buy shares of a stock that go ex-dividend on the next day, sell on the ex-dividend date, and immediately buy shares of another stock that are going to go ex-dividend on the following day. So let's look at a real-world example of the dividend capture strategy with Apple dividends. Then I'll reveal a couple of secrets to make you more money. So Apple declared a 73-cent per share dividend on January 29th, 2019 with an ex-dividend date of February 8th, 10 days away, and then a payment on the 14th of February. Using the dividend capture strategy, you would have bought the shares on February 7th. So remember, you have to own the stock before the market opens on that ex-dividend date, in this case, February 8th. Buying the shares on February 7th would have meant paying $170.94 at the close of trading. Notice that even though the payment date, the day the company disperses the cash dividend, is on the 14th of February, it only goes out to investors that held the stock before that ex-dividend date. Now, the shares did drop on that next day. The first day the stock didn't include the dividend. You would have collected that 73-cent per share dividend, but the shares opened on February 8th at $168.99 per share, losing $1.95 or about 1.1% of the price you paid. As is often the case, though, the shares rebounded through the day and closed at $170.41 per share, or 53 cents below where you bought them on the day before. So you gained that 73 cents on the dividend, but lost 53 cents on the price for a net gain of 20 cents per share. Now, that 0.1% gain doesn't sound like much, but remember, this is a one-day gain. Even that modest gain rolled over every day into a new dividend stock would produce a 34% annual return. Of course, the problem here is with those taxes and then the trading costs. That one-day gain, even at the end of the year, that 1,300 portfolio is only $1.57, so not even enough to cover a $5 trading fee. To cover that trading cost, you'd need a portfolio value of just under $4,300 to make that 0.1% gain cover your costs. That's not to say that the dividend capture strategy doesn't work, though. This was one Apple dividend date. There are others where your return is much more, on the order of 1% or more a day. There are other days when you might book a loss on the strategy. I have two tips, though, that are going to help maximize your returns on this dividend capture strategy. First is to focus on larger companies that pay dividends of 3% or more. Smaller companies with a market cap under $5 billion just tend to have bigger price swings, whether it's related to the dividend payment or not. That's going to increase the risk that your share price drops greater than the dividend amount on that ex-dividend date. Getting that higher dividend yield is also going to mean a better chance at collecting more than the shares drop on the next day. Now, the second tip here is to use this strategy in a tax-advantaged retirement account like a Roth or an IRA. That way, no matter how long you own the shares, you won't pay taxes on the dividends. With a Roth account, in fact, you'll never pay taxes on the dividends you collect. So that dividend capture idea is the main dividend calendar strategy, but there are a few others that, while they might not be as popular, are just as good at producing higher returns. Another strategy is looking for stocks to buy on the ex-dividend date to pick up those shares at a discount. The idea here is that investors overreact initially and the stock price usually rebounds from that ex-dividend sell-off. So if we look back at our Apple dividend example, we could have gotten the shares for $168.99 at the open on the ex-dividend date and made a 0.84% return by the close. Now remember, you're still going to have those tax problems if you sell immediately. Price gains are taxed at those lower capital gains rates only if you own the shares for over a year. If you were to sell your shares that day, then you'd pay regular income tax rates on the gain. Still though, this can be a great way to pick up long-term holdings or even on that shorter-term gain if you hold it in a retirement account so you don't get hit by those taxes every single year. Now another less followed dividend strategy is just buying stocks that have recently declared a dividend increase, especially if that increase is above the normal annual increase they have. Now this one is harder to follow because you have to check on that dividend increase and then compare it after a company makes its dividend declaration. Still though, it's a fairly simple strategy. You look for dividends declared on the day and then go to Yahoo Finance to look at the dividend history for that company. You can then compare the percentage change from the most recent dividends to see how much they've increased in the past. Now Yahoo Finance is a great resource for a lot of different information. So I'm here on the page for the Apple stock, then I come down to historical data. On this page you find the share price, dividend data, and any splits on the stock. So I'll change the dates to get 5 years and then go over here to show dividends only and click on apply. This shows me all the dividends for Apple over the last 5 years, and I can see when they were increased and by how much. The idea here is that the dividend increase is a point of confidence in the company and its business growth. Management and the board of directors usually takes a very conservative look at dividends to make sure that they have sufficient cash for growth and the yield payments, so increasing the dividends means they're confident in that continued business growth. That confidence should result in a higher valuation for the company and higher dividends in the future. Now, there are a few dividend funds that you can buy that mimic this approach. The Dividend Aristocrats is a special group within the S&P 500 of companies with 25 plus years of consecutive dividend increases and a market cap over $3 billion. There are currently 57 stocks that meet the criteria, and it's tracked by the ProShares S&P Dividend Aristocrats ETF, or ticker NOBL. You've also got the Vanguard Dividend Appreciation ETF, ticker VIG, which tracks companies with a record of consistently increasing their dividends. Now, the Vanguard Fund doesn't explicitly invest in the aristocrats and has less strict criteria on those consecutive increases, but I like it better for the lower expense ratio. You see here that the two funds follow each other pretty closely, so that 0.25% difference in fund fees each year can really make a difference. Now, if you love dividend stocks as much as I do, we've got a video highlighting dividend stocks that pay monthly, how I find them, and some secrets to dividend stock investing. I'll leave a card here in the corner, so click through and check that out, or the link in the description below. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments below. We'll make sure you get an answer in a future video.